Welcome to the Imagine Golf podcast Beyond the 19th. I'm your host Raj Narayan, and today I chat with Tim MacKinley, Managing Director of QUANTA Investment Funds. Now, Tim shares the QUANTA story and their investment philosophy and some great insights on the commercial property market. This is a great episode with a lot of valuable nuggets. Hope you enjoy. Tim, we've only known each other for about 6 months. Fantastic to have you as a Platinum member, and it's been amazing to get to know you and QUANTA and the rest of the team at QUANTA. And look, I'm very, very thrilled to have you here on the podcast, so welcome.
Thanks for having me, and we've had a great time since we've been with Imagine for the last 6 months, so it's been great.
Fabulous. Look, let us start at the very beginning. Tell us a bit more about yourself and your background. You've got a great background, so just share a bit more about that, the journey of how you got into being at QUANTA.
Yeah, sure. I was born in Canberra, went to school down there till they finished school down there with the Catholic school down there at Padua Catholic College. Mm-hmm. When I finished school was around the late 1990s,
Yes.
and at that point in time, Canberra didn't have a culture where people were going to university as a sort of as the first option. So I think about probably 20% of people went. A lot of people went straight into the workforce, and I was one of those. So I went off and did a job at the time that was a bit of a gap filler, but ended up coming into the Y2K era.
Oh, wow, yeah. I still remember all that hype about it.
Yeah, it's crazy.
And then nothing happened.
Yeah, absolutely.
I know, everybody was waiting for something to fall apart in that
and the benefit,
D-Day.
the benefit for me and a few other friends from school was we were picked up with a large IT company, Fujitsu at the time,
Yeah.
who looked after Coles and Woolies and St George and CBA, the back end, also their front end as well, so their counters, etc. And they put us through all the training from about 1997 in preparation for
Y2K.
And we were on great money. We got great training and we got a great career very quickly. And so we're quite fortunate that university were able to skip past and end up in a good profession. We all sat home on the night of the change of the millennium. And of course, at 3 o'clock in the morning, we all called each other and said, well, on a very old mobile phone at the time. Nothing
The flip phones.
The old flip phone, we had the old Nokias, the flip phones when they first came out.
That was the coolest thing at the time.
It seemed cool, but you look back and think maybe not so much.
Exactly.
So that was where I got my first, I guess, professional role, and that was as a systems technician. And sort of moving along, I did that for a while, and I was lucky enough with that particular business in 2003 that our work syndicate won the lottery. The Monday night lottery, yeah.
Oh, wow.
Yeah, so we won between 11 of us 2.5 million.
Oh, wow.
Yeah, so I was a young fella then, and was very happy to have about 250 grand or so in my account. About 10 days after the draw, I watched the draw, which was unusual. I'd never watched it in 12
On
months.
TV?
Yeah, I'd never watched it in 12 months of paying for that $5.60 a month it was. And I quickly thought maybe Canberra's a bit cold and I don't have a girlfriend at the time when people usually settle down, and I moved to Brisbane and then went overseas, gave my dad some money. The share market was good. He dealt with the money really well. I came back a few years later after living in various places in Europe with more than I started with.
Oh, wow.
So that was lucky.
You know what they say? One, I don't know anybody who's won the lotto, so you're the first one. Fantastic. But also they say people usually win the lotto, they end up losing it all. So you're like the outlier. You've actually made more from it.
Well, I certainly learned how to spend money, but I definitely left a good chunk with my father, and the share market was booming there. We were buying BHP shares at $5 to $6 and Woodside Petroleum, and Dad did very well. So I came back after a couple of years of having a great time overseas and pretty cashed up when I went there as well. And went back into the IT world, but unfortunately when I was playing Aussie Rules football, I had a cardiac arrest. So a couple of million in one things and did well.
So you must have been very young at the time though.
Yeah, so 28 by the time I came back and had that cardiac arrest, which is in 2006. So that sort of brought me down to earth after... everything was going really well.
Or just when you were playing?
Just playing. I was talking to the team at half time. I was a captain and just collapsed. And people thought I might have fainted, but resus started, the ambulance came. I was shocked 10 or 12 times on the way to the hospital and wasn't looking good. But I pulled through that. And with anyone who's ever had a cardiac arrest or epileptic fit of sorts, you can't drive for 6 months.
Is that right?
Yeah, you're actually not allowed to. So I had to change from being on site doing systems work or IT work to being in an office, and that sort of led me down the recruitment path. So I started helping the recruitment teams in the business to find other people because I couldn't get on the road and go to the various sites. Which then led me into a sort of a HR role, and I started coaching football instead of playing immediately, and I've had about 16 years of coaching Australian rules football.
Yeah.
Which kind of got me into this leadership piece, and I had been the captain of the club, and that started to become something that was, whilst I hadn't had all the technical experience of the university degrees, and I claim that I'm not the sharpest tool in the shed, I think my leadership skills started to become prevalent. So it was a sort of a series of things that got me into
such an interesting journey, and also like a lot of setbacks and how you come out stronger from them. That's pretty impressive as well, because you think as a young person having a cardiac arrest is a big thing. Even managing the money from the lotto was managing that a little bit, and then you have that happen to you. It was a bit of a 1 in a million as well. And there's a few demons that come in with after that, but I think I was pretty resilient in that regard. And the next minute I'm a HR manager for a property fund, and that was about 10 years ago. I moved through the HR piece and the leadership piece, and the person I was working for put me across various teams to lead the teams, even though I didn't have a lot of knowledge about some of the areas. And I guess over that period, I learned a lot about the industry, commercial property, and moved then into a sort of corporate operations, chief operating officer, and here I am today as the managing director of QUANTA investment funds. And I'm probably one of those examples of, I think there's a lot of value in university, but it's not. It's not always what you need to get to. I guess for me, running the company in some regards, yes. Yeah, and look, the world is changing as well. I still remember back in the day of the Nokia flip phone. I had the first one. I thought I was the coolest. I thought I was the coolest person because I had the first
flip one was a real big deal.
When I first got the flip one, and I still remember saying when the Apple phones came in, I'm like, who would get this? Because I would be able to text underneath the table with the Nokia, because you can feel the
little dots.
Dots. So you gotta press it 3 times to get everything. So I said, how would you even have a phone where you can't even feel it? But now I can text with my Apple phone under the table as well.
It's amazing, isn't it? Because you think to yourself, I remember.
But you gotta know where the key is.
And when I first got it, I thought, why would anyone want to text each other? Just ring. And I still have that theory a little bit. I mean, of course, I text people, but they were the days of.
I'm a big caller. Like I like calling myself. But I think it could be Tim. We just come from another generation, maybe, maybe. But and also, I love how you said, look, I used to be able to go there, and because I couldn't drive, I couldn't go to the client. But these days, I guarantee you, 90% of all staff in tech companies don't ever leave the office. Nobody drives, nobody comes anywhere anymore.
The remoting in of such it's so big, wasn't as common, but now you can remote in to do anything really. But it was a real game changer for me. And at the time I didn't like it, but it's probably steered me to where I've got to today.
So look, I mean, amazing journey, like coming from, as you said, like you didn't have an academic background, but then you just really been very resilient and also like, taking advantage of all the opportunities you've been given to create this role. So fantastic, well done.
Yeah, there's one. I also owned a small business for about 5 years when we had our first child, and that I bought that for not a lot, but I sold it for 5 times what we bought it for, and it probably just showed me a little bit about when when you've got to put food on the table. Based on what your income is versus someone paying you, and what you've got, every dollar counts. It was a very good learning curve for me about watching your pennies and making sure they work for you. So I probably missed that part, but that was one of the biggest learnings I had, and then taking that approach into other businesses was, I think the people I worked for or had worked for appreciated that approach.
Yeah, no, that's a great approach. I wish I had a bit more
all
of
about this.
I know all about this, but I wish I have a little bit more discipline. I have my bookkeeper here, Natasha. Every day she comes here and she always says, like, Raj, what's this? Because I spent some more money. I like spending a bit of money. I always say you got to spend money to make money, but sometimes you got to be prudent as well.
Well, Imagine's a great example of that, right? Where we're investing in the network.
Yes, that's right. And then you get
something back out of it. That's right.
Absolutely. So look, obviously you worked, in the HR roles. You worked in another fund. What made you come out and create QUANTA? Like, how did that happen?
Yeah, well,
tell us the QUANTA backstory.
Yeah, the QUANTA backstory. There was a group of us actually, and our founding director, Stacey Jones, she sort of broke away effectively and said, we're going to go and kick off another fund, and that was because we had a different philosophy on how we wanted to deal with our investors. And our fund's a syndicator where we put property out for investment. We have some bank debt and we have the equity from our investors, and we really wanted to be more transparent up front. We wanted to build the relationship, and we felt like maybe that wasn't happening in the previous fund that we're at, and that's been overwhelmingly successful. We'll be in business 5 years next year. And when people are putting, anywhere from 50 to a million, 50,000 to millions of dollars with you, you've got a lot on the line. You're looking after generational wealth and superannuation, and that can go all the way down to kids and grandkids and so forth.
Yeah.
So we think we do a really good job of getting to know people and them getting to know us, of course, and then looking after their money with a lot of responsibility on our shoulders. But also, I think we definitely like to spend the time with them to make sure that they're comfortable that we're going to do what we say we're going to do. And that's the big thing. We've got to do what we say we're going to do. If we're going to build a fund out and we think these are going to be the returns and this is the strategy of the fund, in our game, if you don't deliver on what you're going to do, people are quite fickle. Even though we've got a great group of investors, of about 600 active investors, you've got to keep delivering, and that's the part that... with QUANTA, that's the part that we're very focused on. We've got a group of people who've been working with each other, 25 staff. Most of those people have been there for more than 5 years or working together for 5 years and longer, and particularly Stacey and myself. So I was very supportive of the decision to go and do that, and I'm really happy with where it's at now. We've got $265 million of assets under management, and that's growing all the time, responsibly growing. You don't want to buy things for the sake of it. So
that's right,
it's moving forward really well.
No, I love your investment philosophy that you talked about. Elaborate a bit more on that. Obviously, I come from a banking background and I've been in this space a little bit, but I love this, kind of transparency and looking at the investor returns and that focus, because you have so many funds out there, like, investing, and sometimes you have a return and sometimes not. So I think it's really great to have that kind of philosophy. I think it's quite refreshing.
Yeah, Brisbane's so we're Brisbane based. There's a lot of fund managers in Brisbane.
Yeah.
We see a lot of information memorandums that go out that seem a little exaggerated to us in terms of the final return. We're very focused on, for our self-managed super fund investors, a monthly return, because they're not in work generally. Or if you've converted earlier, you are, but they like the monthly income. My mother and father are very heavily invested with us. So we focus a fair bit on the distribution. We always want to get people out for more than they put in, of course. So if you put $1 in, we like to aim to get at least $1.20 or $1.25 out. But it's that monthly income that people really like about our fund. And that's where we, I guess, for our appetite and for our investors, we look at high-yielding properties.
Yes.
And that means, Raj, for us, we might only buy 3 or 4 things a year. It'll take us 3 or 4 months each time we buy something. And that might be for a total of, we buy things around 20 million, give or take. We like to deliver 8% plus net returns, which our investors really appreciate. But we're quite disciplined. So there was a time there through that interest rate hike cycle where, it was at late 2021, that, we didn't buy anything for 18 months. The market wasn't good. And when we're not buying, we're effectively managing heavily. But that's the part that makes us profitable. But there was no point buying things for the sake of it. So that's the other part of our business. The best deals we can do are sometimes the ones we don't walk away from.
Exactly. I always say the value of any business is what you can say no to. Because people always think it's all the things you say yes to. But it's, better to be do less things really well than so many things not so well.
Exactly, our philosophy too. Let's do what we do really well. Let's not extend ourselves too far. So we're not buying $100 million assets. Maybe one day we will. Let's stick to our lane. We buy things. We bought the last few things around Brisbane, but we're all up and down the eastern seaboard, wherever there's value, and our investors follow us really well. I think in the last 4 months we've raised about $27.5 million for about $45 million worth of assets, and that was all done in sort of a week each time, which is great support for us. We're happy with that.
Oh, fantastic. Now, obviously, you talked about having 265 million funds under management. I mean, obviously, that's a big growth Because when did you start?
We started into 2021. We've
2021,
bought sold a little bit on the way through, so we're going well.
But just 4 years, and 2021 was the COVID year as well. So basically 3 years.
Hard time to start a business in our game, yes.
I tell you what, because we started in 2021 as well, Imagine Golf, and interestingly, I thought I was being very brilliant starting. I thought COVID was over. So I thought I was starting post-COVID, because at the end of 2020, it looked like COVID was finished because there was 0 cases and all of that good stuff. And then obviously we went through all the lockdowns and then restarted in July 2022. So being a similar age in terms of the business, 3.5, 4 years, that's significant growth in such a short period. So tell me a bit more, how have you managed to create that growth?
Yeah, it's an interesting question, because not only was there COVID, but for us, the interest rate cycle of 14 increases, that can sort of demolish an industry like ours, because when you buy an asset, you have, as you know this for sure, Raj, you take on debt, you forecast the debt out, and like hopefully most funds do, we have a contingency in that debt. And I remember when we bought our first couple of properties, we had 25 basis point increases as contingency. Well, they went well past that. So you
it was every time there was a rate review, there was an increase.
It was just
kept going on and on.
It just was crazy. Let's not forget that it's only come back 3. After those 14. So we had to really manage the funds very, very closely. We had to, of course, keep them fully leased, all our buildings, which we are 100% leased across 8 out of 9 of our funds. We had a retail fund at the time, which had some regional assets in it, and retail suffered severely in COVID and take a long time to recover. I will say the retail market's held up really well in the last 3 or 4 years, and we might talk about that later. But it was really attention to detail and hard work, and making sure that the team is being as proactive as they possibly can be. So whether that's renewing leases, whether that's doing some work to the properties to make sure that they remain leased. It's looking at the debt. So we've got a fellow who works for us. He was with the bank for 25 years. He's forever at the bank for a better margin. We've got margins now, Raj, at like 130 basis points or pips, so that's really competitive. Back in probably before COVID, you're talking 200 basis points as your margin on the cash rate. So, we're forever trying to chip away at saving the costs and running expenses of those properties, which I think we did a really good job of. We only had one fund where we had a slight change in distribution that we've moved back up now. Otherwise, we paid our distributions as forecast all the way through.
Oh, wow. Which was, through this whole change.
Yep.
That's pretty impressive there.
So we're looking for more interest rate. And look, we bought a lot. We bought 8 buildings in the last 2 years, and they're all in great shape, as well as the ones prior, but those ones take a little bit more management when you bought them in that cycle.
Exactly. Yep. And that's why it's so important as well, what you said about all the things you didn't buy. So that's quite important, because you don't want to have more and more.
Yeah, we spent about $300,000 on 2 buildings together. We're going to put together, whether it's on consultants, whether it's on looking at all of the hours in the office, whether it's sending out people to do all sorts of things to like technical due diligence and things like that on the roofs, all the building reports. We spent probably 3 or 4 months looking to raise that. We had one item that was sticky with the vendor that they wouldn't concede on, and we had to turn around. We calculated that to be about $275,000 to $300,000 of cost to us, and that's just part of the world we're in. But it was a good one to walk away from in the end. We were happy with that. Not necessarily the outcome, but we were happy that was the best thing.
That was the best thing at the time, And look, and it's so important, because sometimes you think, obviously this, like you don't want to worry about the sunk cost and make the wrong decision.
No, because the reputational damage of buying the wrong property to us is something we'll sit in the war room, and every time we look at an asset, and we'll talk it through for hours and hours and hours and weeks and weeks and weeks. Our team's got a great bunch of experts in it in all their areas. They'll run, as I said, 4 month due diligence programs before we take that leap. And then on the back of that, we've got to check on the investor support. And investors seem at the moment, they're really liking medical, so that's what we're trying to deliver. They're really liking industrial still. Very sheepish on office. We have bought a fully leased office building in Milton in the last 12 months next to Brisbane. Slower raise than others. So people are still a bit concerned about office, but appetite for medical, appetite for industrial, and retail's quite standard.
Standard going up. So look, obviously you only predominantly, You're only in the commercial space, commercial property. So tell us a bit more. I mean, you obviously see the market and where everything is headed. Tell us a bit more about what's happening and kind of where we've come from, but where we're headed.
Sure. Well, where we came from in the last.
Look at your crystal ball. Tell us what's going on.
Yeah, well, we can maybe talk a little bit about our view on interest rates as well, because that's interesting at the moment. But the market had an issue probably 12 months ago for about 18 months. So let's call it, say, 3 years ago, where the interest rates started to rise. It was a really hot market in commercial, and we all know it's still a very hot market all the way around Australia, basically in residential. I mean, Brisbane's silly with residential.
Going crazy,
And so you had all these vendors coming to the market wanting pricing that was pricing from 2 years previously. And so as the debt costs went up, funds like ours said, we're not paying that sort of money. You're going to have to take a haircut on that, 10, 15, 20%. And that's kind of where it sat for us. We thought roughly it sat for that. Industrial was probably the outlier where it stayed pretty steady. So we saw this sort of 2 years of not a lot of transactions. They dropped right off the face of the earth in this country. No one was buying anything, and no one would sell for less than what they thought the price should have been, previously. So that was a really interesting time. Again, discipline need to be applied. In the last 12 months, we've seen the activity really increase. If I can just, I guess, talk about retail, after COVID, retail's probably held up as good as any other sector, where if you can buy a fully leased retail centre of any sort, neighbourhood through to one of the large ones, you're really probably not going to buy it better than sort of under 7% as a yield. So that's remained really tight. It seems like the tenants are trading well again now. It seems like more deals are being done back in those centres. So whilst they're hard work, because there's a lot of tenant interaction you've got to have, our investors still haven't lit up too much on the retail, and particularly at sort of sub 7% returns. Industrial was really interesting because, as we know through COVID, all the supply chain went crazy. But when you go into an industrial property, you generally take on a 7 to 10 year lease. So if you think about, let's say, 2017 before COVID, you got about 5 years into that lease at a pretty good rent. Then everyone was looking for space in industrial. And so the tail of that lease for the remaining 5 years was at really low rents. So if you bought right, when you went to reset that rent, those rents were much higher, and you get much better bang for your buck when you bought. So that's when people realised that was coming, and they started to increase the prices, and the cap rates or the yields went down. We've been lucky that we bought some stuff in larger regional industrial areas for about 8% return. Generally off market, not dealing with an on-market campaign where there's a lot of people bidding for the same thing, fully leased. But otherwise, the industrial sector is strong. We've got quite a few things in an area called Paget in Mackay, off the mining area there, the Bowen Basin out there. There's 0% vacancy in that area for anything over 2,000 square metres.
Wow.
So if you want to go and find a shed with 2,000 square metres, there's currently nothing available. And to build in a place like Mackay or most other industrial areas, or anywhere, we know how expensive trades are, there's just not enough new development coming on the market. So they're a great asset to have, and you should be able to release or lease again to another tenant. So industrial is still a great market, very popular. Office is really interesting. So the office market in particular is the one that's softened a lot.
Obviously,
due to the whole work from home situation.
But I think it's coming back, isn't it?
In our town, it's right back. In our town, it's in actual fact, Brisbane's got the lowest rate of vacancy as the rents increase. So it's got this great graph if you look at it. Knight Frank put out some research every year, where our vacancy in total is now under 12%. In the premium and A grade properties in the Brisbane CBD, you're under 5%. You're sub 5% vacancy. And that means...
That's pretty impressive, isn't it?
Well, the Olympics coming as well. They'll all go out to the fringe areas, and that's where we've just purchased, in the fringe area. We think that's where things will fire up. But we bought that at about an 8.5% return. But otherwise, investors are still spooked, and particularly with our self-managed super fund investors, they still see it as people are working from home too much. And we only have 1 day a fortnight in our office from home because we get so much done collaborating. I'm not sure what you do here, Raj, but...
We're the same because, I mean, early in the day, because I have a very young team as well. So all this working from home and everything is maybe okay to get work done. But how do you have, the culture, the training, the development? If you can bring young people in who've never worked anywhere else before or have minimal work experience, and they're just sitting in their house doing something, I feel like I don't know where the next future generations will go. They'll have no skills.
You wonder from a promotion point of view how you get in front of people to move through the ranks. But it's definitely Brisbane's very busy in the CBD again now, as I talked about that. And Melbourne's the other end of the scale. They've still got all sorts of problems down there. We think there's going to be great buying there. It's just at the right time because the buildings going down there for office buildings are going for 10% plus at the moment. It's sort of almost giving them away to a degree. But the Melbourne people, because we've got groups of investors in Melbourne, Sydney, Brisbane, all the way around the place. When you mention should we buy something down here, they say don't touch it.
Because the Melbourne market has been the worst
the government's just all kinds of problems.
They're just ruined,
So anyway, the office sector's still got growth in it. I think it's still good buying. If we could get our investors to back it more, we'd buy more probably. So you're buying things upwards of 8%, even in the CBD that's fully leased at the moment, which is probably more like 6 and 5.5% 5 years ago.
And then what do you think about Sydney and Melbourne office space? They're also coming back up?
Sydney definitely is, and the rents are increasing here. Melbourne's just still stuck in that limbo of no one. The incentives are really high down there. The rents haven't really moved, and the vacancy is slowly moving. But that's what we like to do: buy counter-cyclically when we can buy. When the market's off, it's just pushing the button. You don't want to push it a few years too early. But also you can't time everything perfectly. But I don't think our investors would follow us down the path of Melbourne property at the moment, particularly in office. But we like office. We just think there's so much value there.
I think so too. And I think, as you said, you don't want to be buying the things that's doing really well because obviously there's a price arbitrage at some point to come and buy it at the low.
That's the philosophy for us as well. Buy where we can increase rents, grow value, do refurbishment, add some other facility or amenity into there and grow the rent because ultimately your property's not worth anything unless you've got rental income.
Rental income, exactly.
And we're always protecting that as much as we can.
No, fair enough. So that's quite interesting. So where do you see the future? Like, do you think Melbourne will improve, or what do you think is kind of coming our way?
We see a lot of future in Brisbane, but you don't have to be a genius to work that out. If anyone's travelled to Brisbane that is listening to this, it's a completely different place than it was even 5 years ago. And I know I've met with some people in the planning area of council there, and they're basically working on this plan that once we get to about 2030, outside of the 2032 Olympics, the development approvals will start to be cut off, and they'll beautify that city. So any development that's happening now up until sort of 2030 will be pushed through, and then they'll focus on making sure there's no half-built buildings or developments happening as well. So that was an interesting meeting to go. The Olympics are plotted right around the CBD. There's some great things happening there, but the future, we think, is in South East Queensland, not because we live there and because our businesses run from there, but we see some great growth there, and the statistics, wherever you look, will tell you that. Sydney, we'd love to buy in because there's still value here in Sydney. There wasn't any value pre-COVID. There was just none. And I think our investors, we've got a great cohort here, would like us to buy something. We had a look at the Manly Wharf very closely for a while. We got pipped on that. That was actually quite a large purchase. We even had a look at Campbell stores down there in Circular Quay. A large purchase, but couldn't quite get there. All off-market. Off-market's the real place to be. And for us at the moment, while we're transacting a lot, you get more off-market deals coming in. There's a few things. Is it Norwest?
Yes, in Norwest,
Is it Macquarie Park?
Macquarie Park is near where I live.
Right. We've looked at a few assets there.
A lot of growth in the western suburbs at the moment,
So we looked at a few things there for sort of plus 8% returns. We're probably wanting them to be plus 8 and the sellers probably want them to be sub 8. So we're sort of battling, and we like to return 8%. That's really nice for our investors to do. We think Sydney's got value still. And we think Sydney's probably in a cycle where you don't often have the opportunity to buy at the pricing that it is at the moment. It's just getting the right thing. And then, like I said, Melbourne. Perth's going reasonably well. We've got an asset in Tasmania, which we think is okay as well, as in what's happening in that state. So, we otherwise, we're pretty focused on where we live. We think that when we manage things when they are close by, in particular, we can manage the hell out of them almost. We can really bring the most value out of them, which we've got a couple of CBD assets in Brisbane that fully leased. One was bought with us 50% vacant, and we're fully leased. So the value for the investors is huge.
Yeah, fantastic. I mean, that's really good to hear. And I think as well, even in Sydney, obviously I keep talking to so many of our members, more and more people are putting their investments into Queensland outside, because
the population growth, all the things, the city's really.
Yeah, they may live here, but certainly when you're looking at investing, you kind of want to find that opportunity where you get the higher returns.
Yeah, and it wasn't
from an investment perspective.
It's turned that way. So we weren't saying the same thing 6 or 7 years ago, but I think there's a big run up now. And then it'll be just a matter after that of when does the bubble burst?
Yeah,
because when the Olympics are here.
The reality in Australia is the bubble rarely ever bursts.
Yeah,
because remember they used to say during COVID the prices will go down or whatever, but even then it's been like small fluctuations. It's not like the market has crashed or anything like that.
No. The interesting part now is the last 3 weeks of interest rates, and the sort of the talk that they could head the other way and inflation sort of creeping up again.
So what do you think on that, Tim? What are your thoughts?
Well, my thoughts they come from the experts in our team, in our transactions team, in our fund management team. As I said, we've got a fellow who's been with us for 7 years. He was with the bank for 25 years, and I call him a bit of a banking nerd. He's always talking to the people in the we bank with, get debt from all the big four banks. Look, they're starting to model in a flat line. So we're getting debt at about total cost of about 4.8%. We have a contingency of about 5.2. So we've got that contingency built in. They'll build in a fraction more. Yeah. We think there might be one more decrease, like everybody has spoken about. But we ultimately think that we've got to start building in that there could be one uptick.
Okay.
Yep, and the 25 basis points next year.
And you think there'll be an uptick?
We think there's possibly an uptick. Yeah. We're going to take that approach in when we're building our models out of what we're buying, which is really disappointing.
More conservative and disciplined. That's good.
Yeah, we are a bit more conservative.
Yeah, it's better. Yeah, exactly.
Yeah, and he in particular, Aaron, is very conservative. Yeah, he twists his arm a bit on things.
And I tell you what, I think it's a good approach to have, especially in the space, because you're always happy to be pleasantly surprised, and
Totally right. That's the thing. Like I said to you before, we're looking after generational wealth. People have worked very hard to build up their super, and we have other people other than super funds. In actual fact, I was on chatting with a fellow on a podcast last week who was talking about 40,000 new SMNFs came in last year, and that the demographics moving down into the 40s and late 30s now for people cutting over from their own super to get control of their investments and what they're putting their money into. But in particular, we don't want to do any damage. We only want to enhance people's wealth, and so we take that very seriously. So we'd rather be conservative and do all the things we need to do before we buy anything.
Fantastic. Look, you've shared a lot of insights around where you think the market's headed. I always love hearing from various experts and what their views are, because it just gives you a much better understanding of different industries and segments. What about Quanta itself? What does your future for Quanta look like for the next 5 years?
Well, we're still focused on building trust with more investors. And what I mean by that is, whilst we have 600 very active investors, and we're putting on about 20% more investors every year, we get a lot of referrals, which I think when you're putting thousands, if not hundreds, if not millions of dollars into us, referrals are a good thing. So it's great that we receive that. We at 265 million, our vehicle is most profitable person for Quanta is at about 500 million. We don't have to add too many more people. Yeah. We've managed up to $1 billion worth of assets. So we're trying to build the machine up, as I said, responsibly by buying the things that work for our investors and good long-term quality assets. We've got, as I said, 25 people. We've forecast we'll add another 2 or 3 people as we build the funds out. But our main aim at the moment, which is why I'm sitting here talking to you, which is why we met, is we want to meet more people. And we want to meet those people. We want to get to know those people and get them, they get to know us. and then see if we can help them build their financial futures. And I know that could sound a bit, I don't know if I could say wanky, but it's it's important. I've got a bunch of family and friends in our investments, almost over 7 million through my network. Yeah. So I treat it very seriously.
Yes.
I want to have family.
You can have exactly.
Yeah, I want to have a nice Christmas. So we're always out there trying to meet people and to do the right thing with their money, and that takes time. And it's never just here's some money and they walk away. We're just keen to meet more people and keep building our reputation, keep building the brand.
No, fantastic. Yeah, no, fantastic. Well, you'll meet more and more people of the Imagine community.
So I'm already doing it, right?
That's fantastic. Oh, that's fantastic. That's good. So look, let's talk a little bit. I mean, it is a golf podcast, so let's talk a little bit more about the golf as well. Tell us a bit more about your golfing journey. How did you get into golf? And obviously, you're a keen golfer, so tell us a bit more.
It's not as exciting.
You're a junior golfer or something like that.
I wasn't, no. I listened to Rich on your last podcast, and it's not as exciting as his story. No, when I came to Brisbane, we lived near the CBD, and Victoria Park Golf Club was, I don't know if you ever went there.
Yes.
Very hilly, very short.
I started there.
Right.
So I started learning golf there in some women's clinic, because I lived in Queensland about 10 years ago, 10, 12 years ago. I went there for just a couple of years through work. I thought, if you come to a new place, you got to, Well,
they had a good driving range set up, didn't it? It was a it
was a great driving range, a
good pro shop. It was hard. It was an easy course and a hard course at the same time. Very short, but very hilly. So anytime you hit a ball on the fairway, just
run off. Yeah, exactly.
We used to get up on a Saturday morning after we had I was like 23 or 4 when I really started to get into it. We'd have a few beers on Friday night and go and play golf on Saturday morning. And I'm a classic case of, one day you went out and you had a decent game. You thought, what will I do with that? So I ended up joining Nudgy. And I was a
member there too.
Yeah, I was a member for 10 years at Nudgy.
Yeah, is that right?
Yeah, and I ended up taking it. I got to know one of the guys at Vic Park, and I took one of the old mats home that used to hit off, and I built a little net cage in my garage, because we had a long garage when we had our house near Vic Park. And I'd get out of the car when I got home from work every day, I'd just hit 50 balls, and I went and got some proper clubs, and I went and got the ball fitting, which that was a really big difference for me. Strangely, I didn't think about it, getting the right ball.
Yeah.
And my handicap over time, I was playing most Wednesday comp and most Saturday comps. I got down to 6, which was good. Single figures I thought I'd never get to.
Oh, fantastic.
And I know how much that takes to... and you're not allowed to say that. I can't say that too loudly because I'm playing that Bonneville thing, and my handicap's nothing like that anymore. No one claimed that I'm a burglar.
Yeah.
And I really enjoyed it. Played again, kids came along, but I love the game. My friends used to say I used to spend $1,000 a week on everything I'd buy, and I was in love with it.
At a time, pre-kids, when you could afford it.
Absolutely. Yeah, I'd go and play golf on a Saturday morning at 6 o'clock and coach football for seniors at 2 o'clock. So it was a really big day, which didn't work overly well when our first child came along. Probably wasn't the favourite person in the house. And then my dad's a fanatic now, and he kind of, as I shifted out, he shifted in. He's a member at Capera up in Brisbane.
Oh, nice,
But I've got to say, Imagine has got me back out swinging the ball again, swinging the club again, should I say, and I've found my passion for it again. So I've been playing at least a few times a month, whereas once a month with the social club for a long time. So, and I'm going to all these fantastic courses, and
that's good.
meeting some great people, and playing with them, more than once, which is great. And so I'm really enjoying it. I've upgraded a few things in the bag. Won the golf bag.
Yes.
Won the golf
bag. That's right. You won the golf bag at that event.
Needed one, and so it was good timing. And looking forward to Bonneville.
I've got one of them as well, the Genesis bag.
The Genesis bags,
Yeah, I didn't have to win it, but I've got one.
So, and that's about my journey. My best score, I hit a 72 at the 71 at Nudgy on one day. It was off 6. Pretty good round, but I haven't got any other great stories. I've been around the world.
Except the fact that you won the trip to Bonneville.
Hey, how exciting would that be if I win it again?
Exactly. Well, you're going to have some stiff competition at Bonneville, because I do know some of the other members who won. One of the guys, Ian Morrison, has been going to Bonneville 3 times, I think.
Yep, I spoke to Ian.
You spoke to Ian, he's been going and practicing.
Yeah.
So he comes out to a lot of our events as well, so that's who you got to beat.
I'm enjoying playing in all the events you've been. We're playing tomorrow. We're playing in Sydney. Then we're going to play in Melbourne again, and we play
at Royal Melbourne. You're coming to that one.
Very, very
awesome.
That. Yeah.
Yes, awesome. So look, amazing to hear you. What's going to happen with your golf team? My prediction: that handicap is going to go back down and down. Not to 6. I think that's gone.
It's back down to 14, I think.
Yeah, 14. Yeah.
Quickly.
Yeah, 14 is realistic handicap. Because I tell you what, look, I used to play off a low handicap as well, but unless you're practicing, it's very hard to maintain a single digit.
Got to keep hitting the ball during the week, don't you?
Yeah, you got to not just hit the ball, but you got to practice. Like you got to go, I don't know, chip and putt, I suppose.
That's where you get the
yeah.
score.
So it's really hard to do it if you have a full life and kids and stuff like that.
And a business to run.
Yeah, and a business to run, exactly.
That's last on the list, is it?
Business,
yeah,
like
yeah.
that.
Yeah, exactly right.
So yeah, that's good. But look, I wish you the very best at Bonneville.
Thank you.
I hope you get the win.
I will be sneaking down to try it out before I go.
Exactly. I hope you win that trip. I heard you. Are you going there with your wife for your?
I'm going to take
Christmas?
I'm going to take a few other friends. We're going to go and just try it out.
Try it out. Yeah, no, it's good to just get a feel for the place. It's stunning, Bonneville.
I've never been.
It's the Augusta of the Down Under, I think. So it's beautiful, beautiful golf course. Very tough, but most of the courses we play, they're all top courses. So therefore, they end up being quite tough. That's the nature of the beast. But look, I wish you the best of luck and
thanks, Raj.
Amazing. I look forward to keeping on hearing the Quanta stories and where you're headed. And fantastic. Look forward to catching up for a round of golf very soon.
Thanks for having me, Raj. It's been great to be here.
Thank you.